Good afternoon, everyone. My name is Ron Berry. I'm with the Celeste Group, Managing Director with them. Today, I have Laura Rosen and Paul Drews with Salesforce Ventures, and they'll be talking to you about more or less their process and how they go about evaluating their ventures. I'll turn it over to them.
Hey all, it's great to connect here. I'm Paul Drews. I'm on the Salesforce Ventures team. I joined the team almost a year ago, last July, so closing in on 1 year. And prior to joining Salesforce Ventures, I've been in the venture industry since 2007, so getting close to 15 years now, with a mix of institutional venture experience as well as corporate venture experience at firms like Battery Ventures, which is a stage-agnostic PE and VC fund, Tenaya Capital, it's an early growth fund, and Tenaya's predecessor, which was Lehman Brothers, their venture arm. And so really excited to be here today and connecting with you all.
Hi everyone, I'm Laura. I'm also an investor on the Salesforce Ventures team based in New York. I joined at a similar time to Paul, having finished my MBA at Columbia. Prior to that, I grew up in London and started my career in strategy consulting, working for private equity firms, investing in the tech space. So very excited to be here and looking forward to the session.
So let's go for the first question. If you would, walk me through the investment process for a typical Series A fundraise, the time a company starts to meet with you and investors start to close, if you wouldn't mind, Paul.
Sure. So we typically will try to start with an investment thesis. So identifying a market or category that we're really excited about and think is ripe for disruption. And then we'll try to identify companies in that category. And we'll have an intro meeting with the company and usually the CEO and the founder. And following that meeting, if it feels like there's a good connection, we'll typically ask for data room access. And our goal there is to really dig into the business metrics, understand how the company is forecasting growth going forward, competitive positioning, market data, things along those lines help us evaluate the investment. And after we've dug into the data room, we'll do something that's a little bit unique at Salesforce Ventures when you compare it to traditional institutional venture funds. And that is, we will set up time with our internal product teams to meet with the company. And there are multiple reasons for that. First, it's certainly helpful from a diligence perspective to have product executives from Salesforce who can meet with the company, understand the product and the differentiation, and help us understand if it's solving a pain point internally at Salesforce. And then it's also helpful for the company because that provides a connection from the company into Salesforce. And so that can be useful down the road when you think about product or go-to-market strategy and sort of business guidance as well. And if the diligence on the data room checks out and our product meetings with internal Salesforce folks go well, we'll typically set up a follow-up meeting with the management team of the company to understand the various roles, meet with key execs on go-to-market and product, and drill into any additional follow-up questions that have come up on our end. And once we have that meeting, we will then, again, assuming that goes positively, we'll have an investment committee, an IC meeting internally with the investment team at Salesforce Ventures. And the goal of that is to get the entire team up to speed on the investment opportunity, our thesis, key areas of concern or risks there. And then from there, we'll get feedback from the rest of the investment team. And after that, we'll typically hold follow-up diligence sessions with the company to help address those areas of concern. And after that happens, we'll have a final deal memo and IC meeting internally to get the approvals to make the investment.
So Laura, I'll turn it over to you. I think the big thing for me is next to figure out here, what are the critical areas when I imagine you hear quite a few pitches, quite a few reviews with various investors. What do you believe are the critical areas they should cover in their pitch deck?
I think first up, presenting a very clear, high level understanding of the problem that you're solving and that the unique insight you have and kind of solution you're building. I think there have been times where sometimes entrepreneurs jump in with a lot of metrics and I still don't know exactly what the product is. And I think then it's important for investors to kind of see evidence of traction. So you may be very, very early, you may still be a proof of concept, but anything you can do to really show that customers and potential customers are really engaging with the product, and that it's something that's really solving a pain point for them. Later on, you may have more in terms of kind of metrics, kind of early revenue, and that's also and sort of related metrics around retention. I think something that's often very helpful is having customer feedback and customer case studies. And I think this, again, really helps us get an understanding of the sort of specific use case for your product. And again, it's helpful to see how customers are kind of perceiving the usefulness and kind of where in the organization the product is fitting. Another point that I find particularly useful is having an idea of the broader competitive landscape and positioning. And this is particularly helpful if you're operating in an area that I may not have a kind of strong background in, or in fact you're kind of creating a new category. So thinking about how you think of your proposition as unique against other possible players in the space or kind of adjacent to the space is super helpful. And then finally, team is incredibly important, particularly at the early stage. We're really backing a team. And perhaps the product will pivot, but if we think you and the people who are around you are going to build something really interesting and be flexible to what the market is telling you around what product they really need and want, that's kind of the crux of early stage investing.
Thank you. You mentioned traction. Could you, that's come up earlier in some earlier conversations. And for a lot of people, it's a question of how do you capture or articulate or things you have found have been very effective to really message to people that there's traction with their offering.
Yeah, and it obviously it really varies by the stage of the company. It could be that you've just launched your beta, but actually you're finding the initial users are quickly propagating that to their colleagues and to their friends, and you're seeing this kind of great grassroots movement. You could show traction in the sense that once you have a user, actually they're logging in and using the application kind of every day or every couple of days, and all of those sorts of early metrics are really helpful. If you can get early feedback from a customer around how they're using it and why they like it, again, that's really great anecdotal evidence. Later on, we talk about traction in terms of revenue growth and the fact that you're retaining your customers. We obviously invest a lot in software, so retention metrics and then evidence of kind of upselling customers is something we spend a lot of time on. Paul, I don't know if you would add anything to that in terms of, particularly for the early stage, like evidence of traction.
Thank you. Go ahead, Paul.
Oh, sorry to interrupt there. I was just going to add on. I mean, I think Laura covered most of that, but traction can take many forms. Again, later stage, there are often financial KPIs we could analyze and look at. On the earlier stage, it could be, website visitors, usage growth. If it's an open source business, how many contributors to the open source project are there? So it really does run the gamut. But earlier stage, there may not be as many data points on the financial side, but again, we'd look to sort of user growth or maybe customer POCs or things along those lines.
And that perfectly, like you said, depending on the stage where they are, you're going to have different areas. But the key thing is to be able to communicate and articulate what traction means. So that's extremely helpful. I think next, terminology-wise, it would also be very helpful to explain how do you differentiate between a corporate venture capital firm or a strategic investor, and how is that different from a traditional VC fund?
Well, first of all, I would say that sort of corporate venture can take many different forms, but I suppose the sort of hub of it is that we at Salesforce Ventures are associated with Salesforce, the broader organization, and that although we very much invest with a financial lens and look to make the same returns as in or better than a kind of institutional investor, we do also have a strategic lens in our investments. And kind of what that means is how does this investment additionally add value to Salesforce, the broader organization, and how can Salesforce add value to the potential portfolio company in terms of kind of leveraging our internal expertise, potentially leveraging the opportunity for kind of cross-selling customers or existing Salesforce customers with this new product. How also can maybe we leverage, broader things like our marketing function and other go-to-market function to support the growth of this company. So I would say in many ways we do act as an institutional fund, but we just have this sort of additional piece that is facilitated by having this kind of huge organization that is, particularly in our enterprise software ecosystem, very much the sort of mothership of enterprise software. I think ultimately, just like a traditional VC, we want to invest in the best company in a growing and exciting market. We just have this additional lens in terms of how it interplays with the existing Salesforce ecosystem. I think also, and this is typical of a corporate venture fund, where you, for example, invest off balance sheet. And that actually allows us to pursue quite a flexible investment strategy where we can continue to double down on our investments through later rounds. We invest from the Series A all the way up to kind of big pre-IPO growth rounds. And we're sort of able to do that because we're not necessarily constrained by the limitations of a traditional venture fund. So it does mean that one can take a slightly different approach in some cases. I said at the beginning, not all CVC looks the same. So especially if we're looking to take investment from a corporate investor, it's worth asking the question, like, what is strategic to you? I've sort of laid out how we think about strategy at Salesforce, but there can be funds with stricter kind of mandates around what they can and cannot invest in. So I think also, just as to kind of finish off, another thing to understand when you look at kind of corporate venture and the corporate investment process is it may impact kind of what the investment process actually looks like. So, for us, as Paul described, it looks very similar to an institutional fund, but we also have this piece where we like to leverage our internal product teams and kind of figure out that strategic fit and opportunity while we look at the investment. So I think that's another kind of point of difference that sometimes it's worth drilling into.
That's good. So tying to that, Paul, I'm deciding on investment. What other things, what else do you consider?
Yeah, I think one of the first things we'll consider is the market opportunity. So we try to be very thesis-driven in our work. And so, that involves identifying markets that we think are ripe for disruption. And, those could be large markets where there are incumbent legacy players that we think a next crop of startups could disrupt, or it could be earlier stage markets that maybe aren't as big from a TAM perspective today, but we think are really fast growing for a variety of reasons. And so that's one of the first criteria we'll look at is this a market that we're really excited about and we think can create a really large standalone business in that category. And things that will factor into that are, is this for a variety of reasons, is this a winner-take-all market? Is this a market where there could be multiple winners? Again, we'll look at sort of the overall size, the growth rates, and we'll do a lot of sort of independent research on to help sort of solidify our reasoning and thinking around that. In addition to evaluating the market opportunity, we'll spend a lot of time looking into the product to sort of identify if there's what we feel is product market fit. And I think there are a lot of different definitions of what product market fit really is, but some signs that we would see of product market fit are the customers or users of the product happy? Is there really a high NPS? When we're talking to customers, we are always asking them sort of, do you like the product? Would you refer to your peers and colleagues at other companies? Another data point that might support that is the net retention. So oftentimes we're looking at subscription software businesses, and these businesses will maybe have a 1-year contract cycle. So we'll look at the renewal rates. Of all of your customers, how many of them are renewing? Is that a high percentage or a low percentage? And if it's a really high renewal rates, that's obviously a very good sign for us. And then we'll also look at like net retention. Are they upselling across? Are you able to upsell or cross-sell those customers? Another big category that we'll dig in on is the competitive landscape. It's something I touched on a little bit earlier, which is, is this a winner-take-all market? In which case, is the company we're evaluating right now, are they the leader in that category? And we'll want to understand how does this company compete against the other companies in the category from a product perspective, from a go-to-market perspective, from a management team perspective. And we want to make sure that our goal is to really try to back the leaders in these categories. I think the last thing, or one of the last things we'll spend time on is if we're comfortable that there's a really exciting market opportunity, we feel like there's great product market fit, feel like we could be investing in the leader in the category, we'll spend time on the investment opportunity dynamics, so the round dynamics. And things that go into that decision are what is the valuation? How does that compare to public companies and to other financings at the Series A level or growth level, depending on which stage of opportunity we're looking at? Because as Laura mentioned, there's certainly a strategic component to what we're investing in, but there also have to be strong financial returns associated with that as well. And so we'll spend a lot of time sort of understanding what the company's current traction is, forecasting out their growth rate, and understanding the interplay between that and what the current valuation is. So we'll sort of do all of that work, and none of those things are in isolation. They're all sort of interconnected in various ways. And once we've done all of that work, hopefully we can get to an investment decision and get to a yes and work with the company to structure the appropriate investment.
Earlier, Laura talked about you're looking at the synergies and like, hey, Salesforce can work with these guys. Is there anything else that you would do very similar or different than a traditional VC firm in evaluation?
I think one thing we touched on is the having folks from the Salesforce product orgs meet with the companies. And I think that's it's great on multiple levels. Again, it helps us with our diligence process, but it also gives that company insight into how Salesforce, sort of a larger business, is thinking through these problem sets. And even if it doesn't result in an investment in that round, it's good to build those relationships going forward. And that's a point of contact that CEO or founder can have going forward to sort of help iterate on their product and bounce ideas off of and things along those lines. So I would say that's one of the biggest criteria that we have that maybe an institutional venture firm does not.
Sense. So to that point, that's good because it really gives you a true idea of like how it fits in your overall ecosystem, an idea of like potential traction and potential opportunity. What else, Laura, I'll talk to you, have you done to really help and enable a potential startup along the way in the acquisition?
So we have our portfolio development team who are very much focused on sort of being keys to the castle for the broader Salesforce organization for our portfolio companies. And they work really hard to set up round tables and panels and to make internal introductions to help our portfolio access the huge amount of expertise that sits within Salesforce, whether that is in sort of go-to-market or marketing or product. And then on the investor side, there's usually an individual investor who takes responsibility for each portco. And I spend a lot of time kind of talking to the portfolio companies and really understanding where we can be helpful, and whether that is by leveraging Salesforce or whether that is even leveraging personal network if they're looking to make a sort of new hire, whether we can help present candidates to them. But I think the big thing here is that there is so much that sits within Salesforce that we can do to support the portfolio. And it's just really kind of helping the portfolio navigate that opportunity within the huge Salesforce organization.
From a traditional VC firm?
Well, I think different venture funds offer value in different ways, and different individuals within venture funds provide value in different ways, whether that is their own prior experience or sector expertise or the network of potential customers they have, or maybe the network of kind of future investors that they have. I think we really differ because, first of all, there's ultimately the opportunity to access Salesforce's broader customer base. And, ultimately down the line, there may well be a true partnership opportunity and a kind of shared go-to-market opportunity. also within our organization, we have an incredible array of experts. Even if you think of some of the companies that we've acquired, and those individuals still sit within Salesforce. So I'm thinking of MuleSoft and Tableau and most recently Slack. So there are already people who've kind of sat across the enterprise software ecosystem, and as a portco, you can speak to those people.
So Paul, I'll turn it back to you. What should a founder consider when thinking about a VC as a partner or as an investor?
Sure. I mean, I think there's a lot of capital in the market, a lot of different types of venture funds that have been around historically, and always new venture funds that are popping up, particularly today. And so I think it's important to think about what you're looking for in a partner, and what value you're hoping that partner can bring, above and beyond just the capital to help finance the business. And I think different investors have different styles and different ways to bring that value. And Laura touched on this a little bit. There are some firms where they have huge operating arms, and they can be really helpful in thinking through your strategies, you're making customer introductions. There are some firms that are former operators or entrepreneurs potentially in your sector, and they might have great relevant experience to help you as you're trying to get to the next stage of company building. There are other funds who have great investor networks and have long histories and understand investing throughout cycles and how to support companies through those cycles. So I think it's very specific to each individual company. What are the pain points? What are your sort of relative areas of strength and weakness, and how can the investors or the investing syndicate help address some of those areas to make your company even stronger? I would say one thing that's really important is these are really long relationships. If you're investing at the seed or Series A level, you can be partnering with that company for 3, 5, 10 years or more potentially. And so you want to make sure, above and beyond just investing with a particular firm or fund, that the partner that you're working with is somebody you want to be on that journey with for the next, near term, medium term, 5+ years. I think that's really important to make sure that you have that comfort level. I think we're seeing that more and more today, where fundraising cycles, because the market's really hot right now, fundraising cycles are compressed, and so there's less opportunity for entrepreneurs and investors to build those relationships. And I think that's something that is truly very important.
Along with this, that's a nice segue. Is there further advice you would give companies early on looking for funding? Things that you've learned, listened, kind of like, hey, lessons learned, don't do this, etc.
The first thing I would say is, we'll talk about how hot the market is today, and how much capital there is out there. But every company journey is different, and so sometimes companies will raise in just a matter of a week or two, and other companies might talk to dozens of investors before finding somebody to say yes. So my one sort of comment there would be, don't get discouraged. It oftentimes can take many pitch meetings and investor meetings and introductions to find the right fit. So don't get discouraged on that journey. There are great companies that have struggled to raise at all stages. So that's the first thing. The next thing I would say is, we see this with sort of repeat entrepreneurs or entrepreneurs who are raising growth rounds as opposed to early stage rounds. Practice really helps. The more you have sort of rehearsed and practiced that sort of pitch, if you will, the easier it is to convey that story to investors. The more likely you are to get somebody who really understands the value you're providing and will commit to that round. I think sometimes, and Laura touched on this a little bit earlier, as an entrepreneur, you're sort of living and breathing that pain point. The investor on the other side may not. And so finding a way to distill all of your knowledge clearly and succinctly is really important. And I think practice helps with that. So, it could be practicing with friends or other investors who maybe you're not even a fit for their firm or fund, but, just using them as a sounding board, I think, is really important. And I think the other thing is, particularly at the earlier stages of investing and raising capital, these are long journeys, and it's not always up and to the right. There are going to be bumps and hurdles you have to overcome, and companies will sometimes have to, go into adjacent markets or pivot their strategies. And so I would think, it's important to talk to investors who understand that, who have been there before and have that experience, because that would be super helpful on your journey. The next thing I would say about that's important as you're embarking on a fundraising journey is to leverage your network as much as possible for warm introductions. So finding folks who can give you the intros to seed investors, angel investors, Series A investors is super helpful. At the same time, if you can't get that warm introduction, don't hesitate to find a creative way to reach out to that VC, whether it's a cold email or potentially a LinkedIn introduction. Sometimes some of those channels are spammier than others, and it's harder to cut through the noise on that. But don't be afraid to reach out cold to investors if you can't get the warm introduction. So I think those are some of the key things that I would think about embarking on that journey. Laura, was there anything there that I left out?
No, I don't think so. I think perhaps one thing is, coming into fundraising, having a clear idea of what you want to get out of it, like what your targets are in the next 12 to 18 months, how much capital you need to get there. And as Paul said, I think everyone's fundraising journey can look very different. But we are also in an environment at the moment where there is a lot of capital, and there are certain areas that are really hot with investors, and sometimes you're seeing valuations really get pumped up. But sort of thinking about what you kind of actually need, what you actually want, and particularly about the partner sometimes over the valuation, I think is helpful. Certainly when I talk to some of my friends raising their seed and Series A, I think it can become a little bit of a conflict for them. Given how many investors are running around desperate to deploy their capital.
You bring up both of you cover this, and indirectly, like you said, nowadays there's a lot of money out there. How do you advise companies to like good money versus bad money? Because not all money is good from that standpoint.
Paul, I'll let you take that.
Well, sure. I mean, I think it's important. It's important to be disciplined. So that if there is a lot of capital and you're in that fortunate position where there's a lot of capital that is looking to invest in your business, I think that's fantastic. First off, but be disciplined. Raise the amount of capital that's appropriate for the business for the next maybe it's 12 months or 18 months. Set goals with your founding team, your board, and try to achieve those. But it's important to diligence your investors. So don't be afraid to ask for references, to talk to other companies where they may be on the board of or they may have invested in. Understand how those founders or CEOs have operated with those investors. What was it like in good times? What was it like in bad times? When you were raising follow-on capital, what was that process like? So don't hesitate. Oftentimes investors will try to do diligence on founding teams, and I think the founding teams is perfectly fair to turn those tables around and try to do some diligence on the investors coming into your company. Because as we said, it's a long journey, and you want to make sure that you have a lot of conviction and comfort working with them.
So I'll open up to the floor to ask questions. While people are prompting their questions away, Paul and Laura, I really want to thank you very much for your time. I don't know if you want to leave the audience with any other closing thoughts.
I would just highlight something Paul touched on earlier, and that is that I think everyone's journey looks different, and that it's not always a smooth journey, and sometimes you may have to kind of rethink product, especially in the early stages. Perhaps you thought that you were solving one problem and then something else becomes actually more significant. And I think don't be scared of that. And when you look to kind of raise money, find investors who will support you for the whole journey through the kind of ups and the downs. And I think that's where kind of the personal diligence and finding an investor who you want to have sit on your board and who you want to have regular conversations with for maybe the next 5+ years is really, really key.
And I would just reiterate that no two stories are the same, and even when things look really easy from the outside, oftentimes there's a lot going on under the hood, and so just be ready for that. But otherwise, it's been great to be here today, and I've really enjoyed the conversation. So thank you for having us.
Absolutely.
Yeah,
Thank you.
thank you.
Now, I'll open it to the floor. If you have a question, either just go to your bottom of your chat window, type in the question, or share your camera. I'll give a few moments here. Or I can give you back time to your day. Okay, I'll give it one more minute. Seems like you have answered all their questions proactively. Okay, if there are no questions out there or anything burning right now, you can always follow up. And basically, the key thing is reach out to Salesforce Ventures, revisit them. And again, there you go. Beautiful. Thank you, Christina. So again, along the way, really appreciate the amount of detail in the conversation because I think it's very relevant as people think about this across the board. And it's, as you said, it's not a very easy process, despite what you see on TV. It's very difficult, a lot of homework involved, and a lot of practice involved. And so I definitely appreciate that candor from that respect. So if there are no further questions, I will basically go ahead and we can close this out. Paul, Laura, if you have anything else to add.
No, thank you so much for having us today, Ron. Really, really appreciate that.
Okay, thank you all for attending and for participating in Urban Tech Connect. Okay, you guys have a great afternoon.
Thanks.
Bye, Rob.
Bye-bye.